Credit cards are one of the most widely used financial tools in the modern economy. Millions of people use them daily to pay for goods and services, both online and offline. Despite their popularity, many users do not fully understand how credit cards actually work, how banks make money from them, and why improper use often leads to long-term financial problems. This video provides a clear and structured explanation of credit cards, focusing on the underlying financial mechanisms, the cost structure, and the behavioral factors that influence how people use them. This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. A credit card is a financial instrument that allows a user to borrow money from a financial institution, typically a bank, to make purchases. Unlike a debit card, which uses your own money, a credit card uses the bank's money. When you pay with a credit card, the bank pays the merchant on your behalf. You then repay the bank later, either in full or partially. This creates a short-term loan. Every credit card transaction involves several parties. The cardholder, you; the issuing bank, your bank; the merchant, store or service provider; the payment network such as Visa or MasterCard. The process works as follows. You make a purchase. The merchant sends a request for payment. The bank approves or declines the transaction. The payment network processes the communication. The bank pays the merchant. You receive a bill later. This system operates within seconds but involves complex infrastructure. Each credit card has a credit limit. This is the maximum amount you are allowed to borrow at any given time. The bank determines this limit based on factors such as income, credit history, existing debts, risk assessment. The limit is not your money. It is a borrowing capacity. Credit cards operate on a billing cycle, usually around 30 days. During this period, you make purchases. All transactions are recorded. At the end of the cycle, the bank generates a statement. The statement includes total amount spent, minimum payment required, due date, interest rate. One of the key features of a credit card is the grace period. This is the time between the end of the billing cycle and the payment due date. If you pay the full balance during this period, you pay no interest. The loan is effectively free. If you do not pay in full, interest is charged on the remaining balance. The interest rate on a credit card is usually expressed as APR, annual percentage rate. Typical credit card APR are significantly higher than other types of loans. If you carry a balance, interest is applied daily. It compounds over time. This means the longer you keep a balance, the more expensive it becomes. Each statement includes a minimum payment amount. This is the smallest amount you must pay to keep your account in good standing. However, paying only the minimum leads to long repayment periods. Interest continues to accumulate. The total cost increases significantly. This is one of the primary ways banks generate profit. Banks make money from credit cards through several channels. 1. Interest. The largest source of revenue comes from interest charged on unpaid balances. 2. Interchange fees. Every time you use a credit card, the merchant pays a fee, usually 1–3%. This fee is shared between the issuing bank, the payment network. 3. Late fees. If you miss a payment, the bank charges a penalty. 4. Annual fees. Some cards charge a yearly fee for access to benefits. Credit cards serve multiple purposes. Facilitate transactions, provide short-term liquidity, enable online payments, offer consumer protection. They also support economic activity by allowing people to spend before receiving income. When a bank issues a credit card, it takes on risk. The user may fail to repay the borrowed money. To manage this risk, banks use credit scoring systems. A credit score reflects payment history, Debt levels, length of credit history, credit utilization. A higher score generally leads to lower interest rates, high credit limits. Credit utilization is the percentage of your credit limit that you are using. For example, limit $1,000, used $500, utilization 50%. High utilization can negatively affect your credit score. Financial experts typically recommend keeping it below 30%. Interest on credit cards is usually compounded daily. This means interest is calculated on the current balance, then added to the balance. Future interest is calculated on the new total. Over time, this significantly increases the amount owed. Credit cards are a form of revolving credit. This means you can borrow repeatedly, as long as you stay within your limit, and make required payments. This differs from installment loans, which have fixed payments and timelines. Credit cards influence behavior in several ways. Reduced pain of paying compared to cash, easier impulse purchases, separation between spending and repayment. Research shows that people tend to spend more when using credit cards compared to cash. Misconception 1. Minimum payment is enough. Technically true, but financially inefficient. Misconception 2. Credit cards are free money. They are loans with high interest rates. Misconception 3. Carrying a balance improves credit score. Thus, paying in full is generally better. When used correctly, credit cards offer fraud protection, purchase protection, rewards, cashback, points, convenience. They can also help build a credit history. Improper use can lead to high interest debt, financial stress, long-term repayment cycles, reduced financial flexibility. To use credit cards effectively, pay the full balance every month. Avoid unnecessary purchases. Monitor spending regularly. Keep utilization low. Understand the terms of your card. From a broader perspective, credit cards increase consumer spending, support economic growth, shift risk to financial institutions, generate profit through interest and fees. They are a key component of modern financial systems. Credit cards are neither inherently good nor bad. They are financial tools. Their impact depends entirely on how they are used. When managed properly, they provide convenience and flexibility. When misused, they can become a source of long-term financial burden. Understanding how credit cards work is essential for making informed financial decisions. Credit cards do not create debt. Misunderstanding them does.